Hello, and welcome to today's webcast, Capturing the Breakout in Gold and Gold Stocks, sponsored by Sprott Asset Management. Today's live webcast has been accepted for 1 CFP, 1 CMA, and 1 CFA CE credit. For questions on credit, please use the number in your console. A copy of today's presentation, as well as additional material, can be found in the Documents folder at the bottom of your screen. We also have a brief survey, which can also be accessed at the bottom of your screen. Our speakers will be taking advisor questions. Please type your questions in the box to the right of the slides, and we'll get to as many of them as possible. If you're interested in a one-on-one meeting with Sprott Asset Management, please click the one-on-one folder at the bottom of your screen and confirm the request. A replay of this webcast will be made available, and all registrants will receive replay information by email. I'd like to introduce Ed Coyne. Ed joined Sprott in January 2016 and has more than 25 years of investment management and sales experience. Previously, Ed was a principal and investment specialist for 18 years at Royce & Associates, a small-cap value manager located in New York City, and the investment advisor to the Royce funds. So with that, I'd like to go ahead and turn it over to Ed Coyne, Senior Managing Director, National Sales for Sprott Asset Management. Ed?
Thank you, Natalie, and welcome everybody to today's webcast. With me today are two special guests, Doug Groh and Ryan McIntyre, both currently portfolio managers at Tocqueville Asset Management. Ryan and Doug both are joining Sprott with a potential close in January of next year, and we're thrilled to have them become part of our team longer term. But today they represent still Tocqueville, and we're happy to have them on this special call. For those that aren't familiar with both Doug and Ryan, Doug is a senior portfolio manager at Sprott Hathaway Special Situation Fund. He's a co-portfolio manager of the Tocqueville Gold Fund, and Doug began his career as a mining and precious metals analyst back in 1985 and earned his Bachelor of Science in Geology and Geophysics from the University of Wisconsin and his Master's from the University of Texas, where he focused on mineral economics. Also with me is Ryan McIntyre, and Ryan is a portfolio manager at the Sprott Hathaway Special Situation Fund, the co-portfolio manager of the Tocqueville Gold Equity Strategy, as well as the Tocqueville Gold Fund. Prior to Ryan joining Tocqueville, he was an analyst and associate focused on mergers and acquisitions in the metals and mining sector. Ryan holds a Bachelor of Commerce with distinction from Dalhousie University and an MBA from the Yale School of Management. Today's webcast is going to focus both on gold and gold equity with a detailed examination on several key points. Today we're going to cover the Sprott acquisition of the Tocqueville Gold team, again set to close in the first quarter of next year. We're going to talk about what we believe is the new gold bull market. We're going to do a deep dive into the gold industry with Doug and have Ryan talk a bit more about gold equities from an investment standpoint. We'll give a look ahead on where we're seeing opportunities, both in physical gold and gold equities, and then we'll certainly open up the call for some Q&A. For those that aren't that familiar with the firm itself, Sprott is a leading global gold investment firm. Our mission is to provide clients with precious metals portfolio solutions across all markets. We manage over $10 billion in US dollars in precious metal assets. We offer a global presence in all major gold markets, and we offer industry-leading platform built on top investment and technical talent. Sprott provides a complete spectrum of gold strategies and solutions. We have our leading physical bullion trust, which is a combo of either gold and silver, pure gold, pure silver, or a combo of platinum palladium solutions, which allow you to own the physical metals directly. We offer two factor-based gold mining ETFs that give you exposure either to large cap or senior miners or small cap junior miners based on factors that have mattered over multiple market cycles and our active portfolios. We also offer a full suite of equity solutions, whether it's 40 Act mutual funds, which we'll have starting next year with the Tocqueville Gold Fund, to SMAs and special situation products. We also have several partnerships in the digital gold market, and we provide gold income solutions through our private lending, credit, and debt team. In addition, we have several custom solutions and exploration partnerships and private placements, flow-through investments for tax strategy purposes, and other alternative strategies in the precious metal space. So it's over 30 years of a track record. Sprott is really one of the leading firms in the gold space. Now, as I mentioned early on, I asked Doug and Ryan to join us today for this special call, largely because Sprott announced back in the summer that we are to acquire the gold team and its strategies. We believe that combining the strengths of two gold investment industry leaders will be powerful for our investor shareholder base, as well as for the long-term growth and stability of our firm. Sprott Inc. and Tocqueville Asset Management have agreed to a sale of its gold strategies to the Sprott Asset Management with an anticipated close date of 1Q 2020. The Tocqueville Gold team is comprised of their leader, John Hathaway, Doug, Ryan, and Victor, all part of the transaction. Tocqueville, for those who don't know, is one of the most successful and respected gold teams in the precious metals investment sector, with over $1.9 billion in assets in gold and gold equity strategies with over a 25-year track record. We believe the gold team at Tocqueville will benefit directly from the access Sprott has enjoyed for over 30 years from a technical and investment standpoint. Now, with that out of the way, I want to get into the meat of today's webcast and really talk about a few different things. The first thing I want to address is really what we believe is the new gold bull market, and then I will turn it over to Doug to talk about the gold industry, and Ryan to talk about the gold equity investment opportunities we see in today's market, and then again, finally close with some Q&A. So I want to first go to the first page, which talks really about why people don't care about gold today. And I think this is something that's very evident in the performance patterns. If you look at gold over the last decade, it's really lagged relative to all other assets. I mean, the dollar is even up close to 3%, bonds are up over 3.5%, and the S&P 500 has averaged close to 13% with reinvestment of dividends over the last decade. And gold has basically been flat. So it's no surprise to us that most investors haven't really cared about gold as an investment. But when you go back and look at the late 90s to 2011 when gold peaked, the story was completely the opposite. In fact, this is why you should care about gold as an investment. Gold averaged over 15% on an average annualized basis for close to 11 plus years. The S&P was basically flat with reinvestment of dividends. Bonds delivered about mid-single-digit returns of 6.3%, and the U.S. dollar, which has gained value recently, actually lost value from 1999 to 2010. And in our mind, this is really why you need to be thinking about gold, is that there are periods of time where gold can substantially outperform. And when you take a wider view or a larger landscape view or lens of the gold to S&P trade, gold's done phenomenally well in the last 2 decades as it's entered what we view as a modern era of investing. And the reason why we say modern era of investing is that if you think about gold the last 2 decades, it's become much more accessible, much more liquid, and trades on multiple platforms, whether you're talking about closed-end funds, mutual funds, or ETFs. If you go back to the 80s, the 70s even, or even the 60s, gold was a very difficult asset to allocate to in a physical form, and it was very challenging to get accurate information from an equity standpoint. So we think the last 2 decades has really become the modern era of gold investing and allowed investors to allocate to gold the way large institutions and wealthy families have for decades. And in that environment, most people are surprised to learn that over the last 2 decades, gold has averaged over 8.5%, and the S&P has averaged a little over 5.5%. So over the last 20 years, gold's enjoyed a performance advantage on an annualized basis of over 300 basis points. Most people are surprised by that, and that's including reinvestment of dividends in the S&P. So in our mind, we think now is the time to be thinking about gold, and there are certain cycles where maybe gold underperforms the S&P or the general markets, and there's times where it outperforms. But we think the time that we're in right now is setting the stage for what we believe is the early stage of a bull market. And if you look on page 10, we simply highlight what we've seen in the last couple market cycles. From 2009 to 2011, gold enjoyed over 150% move up, from 750 to over 1800. And more recently, really since the end of 2015, gold has stair-stepped up every single year. In 2016, it was up 8%. 2017, it was up 13%. 2018 was actually flat or actually slightly down, yet it still outperformed the S&P 500 by over 300 basis points, and I'll touch on that in a moment. And then this year, gold's done quite well. In fact, gold and the S&P are up about the same. They're up about 17% year to date. But what we find interesting is that each year, gold has continued to stair-step up about $100 per ounce every year. And we believe that is a leading indicator of the next bull market that's getting started in this space. And going back to 2018, I think it's interesting to note that 2018 was the first year since 2011 that gold actually outperformed the S&P, or at least held up better than the S&P. Again, gold was up about 1%, and the S&P was off about 4%. And on a rolling 12-month basis, from September to September, even into October, gold's enjoying about a 20 percentage point performance advantage over the S&P. So again, we're seeing a lot of leading indicators out there right now talking about why we believe we're in the early stage of a gold bull market. Now, Ryan, I want to switch over to you for a moment because a lot of people think about gold at the institutional level or at the family office level as a necessary portfolio asset. Maybe help share with our audience today why that's the case and why investors look at gold as a necessary allocation over multiple market cycles.
Sure. Thanks, Ed. Now, I think when we speak with either institutions or family offices or advisors, I think the biggest thing for most people is initially to protect their wealth. And that has been one of gold hallmarks over the past sort of 1,000 years, has been used as a monetary instrument. And on this chart that we have here on slide 11 is a great illustration of what it can do in a portfolio, so in the context of your other assets. And I think the main thing that gold does is it really helps to diversify sort of the volatility in any portfolio. So if you see in this slide, it has very low correlation to U.S. equities, which I'm sure is probably one of the most important things for this audience, but also international equities. So when we meet with institutions or families in Europe, it also does the same thing. And I think one of the most important things today, I mean, even the central banks sort of elevating it up one level above everything else, you know, as calm as they seem, they are actually one of the most aggressive buyers of physical gold today for exactly this reason of diversification. And so basically they're eliminating a lot of the currencies that they hold, whether it's euros or yen or what have you, and moving into gold as a new, not new asset, but a higher allocation asset in their mix.
You know, it's funny, Ryan. I spent a lot of time talking to families and multifamilies and advisors and so forth. And one of the families about 3 weeks ago, I asked them, you know, I always like to ask how are they allocating to gold, if they're allocating to gold, and then really more importantly, why are they allocating to gold? And my favorite quote that I've been using virtually every week is, you know, we see gold as our own central bank, that we're looking at gold as an allocation to diversify away from our potential risk in our currency because we deal with families both here and abroad. And, you know, gold has done quite well in virtually every currency this year. And so a lot of these families see gold as an allocation the way central banks see gold as an allocation, which I think is interesting. You know, Doug, you and I were talking about this earlier today about what gold's been able to provide on page 12 from a dislocation standpoint or a period of stress standpoint. Maybe walk folks through this chart a bit and talk about the power of gold over multiple market cycles when there's been periods of stress or periods of dislocations in the market.
Sure. Thanks, Ed. I think this is a very important and powerful chart. If you take a moment and look at some of the periods in time over the last 30 years or so, you'd recognize that gold acts as an insurance mechanism for a diversified portfolio. And is very unique, and I think it's unique because gold is valued around the world by different cultures, different markets. It's not tied to an institutional construct the way maybe the dollar might be or bond markets or equity markets. It is valued by different people in different cultures and for different reasons. And you can see that it really plays that unique role as a diversifier, as an insurance mechanism when there's stress in the marketplace. I often think about gold as a barometer of financial anxiety, and you can see how it's played out here in the last, say, 30 years, whether it was the crash of '87. Gold outperformed right away as the market was trying to get its feet under itself. And then throughout the 90s into the noughts, the dot-com era, gold was a lifesaver for many investors as well as the global financial crisis when gold really shined, as it were, and through the early noughts, the markets weren't doing anything, but gold had that tremendous run where investors were looking for performance, and they found it in gold. And I think the important element here is that it does provide that element of insurance.
Mm-hmm. And I think it's interesting, even the most recent sell-off we saw in the fourth quarter of last year. I think I mentioned this in the early part of the call, but not only did gold go up 5% when the S&P was down over 18, even with the tremendous run we've seen on a calendar year basis in the S&P, gold's still enjoying about a 20% performance advantage from the September high of last year. So I think it's really interesting to see that gold continues to do what it's always done, which has done its job and protect assets in periods of dislocations. Ryan, on page 13, we talk a lot about gold thriving in the real interest rate environment. So often people think about gold relative to other currencies, but really relative to the U.S. dollar. How should people be looking at gold relative to interest rates, both from a directional standpoint and just from a real rate standpoint relative to a Fed fund policy standpoint? How should people be thinking about gold relative to interest rates?
Sure. This is probably one of my favorite charts, actually, because it clearly illustrates in those red boxes where you've had real rates starting to move lower, and you've always had a period of gold price positive performance when that happens. And it's funny, we were just talking before we started the podcast, what a difference a year makes on the context of markets. And if you go back to this time last year, I think everyone was universally convinced that interest rates were going higher. The Fed was sort of doing a good job. Everything was very consistent. Everything was sort of more or less on autopilot. And fast forward to now, you've had almost a complete reversal in thinking and action by the Fed and probably most market participants at this point, given that interest rates are about 100 basis points lower than they were a year ago. And if you look at the gold price, it's exactly corresponded to that change in sentiment and actuality with rates, with its strong performance moving up several $100s this year. And so to us, what this is exactly telling us is the opportunity cost to hold gold is no longer as high as it used to be, given that you actually did have a relatively decent alternative and 200 or 300 basis points a year in terms of interest, whereas now you have basically half of that, and gold obviously does not pay anything every year. So I think this is a very important chart and probably really illustrates why gold has performed so well versus many other things over the past year and the big change.
With that, we do spend a lot of time at Sprott and you all at Tocqueville talking about physical gold relative to gold equities. And what I thought would be interesting today, given Doug's background and his expertise in the gold space, particularly the gold equity space from an industrial standpoint, from an industry standpoint, I thought it would be nice to take a step back for a moment and really, Doug, maybe walk people through what's really going on in the gold industry right now. Forgetting the directional price of gold itself, what's happening in the industry right now that has us all excited about gold equities? And what's really going on in the general market today that people should be aware of or think about?
Sure. It is interesting, Ed, from a fundamental perspective. In many regards, the market's kind of given up on gold over the last 10 years and has not really paid attention. But if you look at it, you'd recognize that there hasn't been the capital available for mining companies to develop assets, to do exploration. And these companies have to replace their resources. They haven't been able to really identify new deposits to develop because they haven't had the capital. So as a result of that, we're seeing a decline in mine supply. We're not seeing projects come on stream the way we did, say, 10 or 15 years ago. So we're hitting a point in the marketplace where supply is getting much tighter. And I think a real good example of what's going on in the space is the consolidation that we've seen over the last couple years or so, and in particular the last year. In my career, when you see the largest producers of an industry come together to merge, it's an important mark in the cycle of a sector. Last year we heard the announcement of Barrick acquiring Randgold, two major gold producers. They could not really operate on their own independently, and they felt as if they had to come together and merge to cut costs and advance each other's projects. And then earlier this year, we witnessed the merger of Newmont and Goldcorp, two also major companies that were looking, to solidify their asset base and have greater access to the capital markets. As part of that combination, we saw Barrick and Newmont form a joint venture in Nevada, which is very significant. This is a joint venture that has been discussed in the marketplace for, the better part of 20 years, but both parties were resistant to that merger for fear of perhaps job loss or control of the assets. But finally, they recognized that they had to combine to cut costs and become more efficient. So we're seeing an industry that's consolidating. And when you see that in the marketplace, it becomes very, very important, I think, for investors to recognize that there's an investment opportunity and there's a shift in the overall fundamental basis for the sector.
And a lot of that is really predicated on, that the gold supply continues to decline. So I guess that whole idea of making those acquisitions to get exposure to the space is probably more important now than it has been in a long time. So what are we seeing from an industry overview right now in the space, and where do you see the opportunities then?
Yeah, well, if we look at page 16, the next slide here, we illustrate how the valuations have come down significantly. The price to cash flow valuation for the industry has come down because of the lack of interest in the space, and that presents an exceptional investment opportunity for investors who have not been involved in the sector, who also recognize that there has been this consolidation and there is a need for greater supply going forward. It is interesting. The small cap segment of the precious metal industry has been really decimated by the lack of capital. We are not seeing the capital available for exploration companies. We're not seeing the capital available for development projects. And it can take anywhere from 3 to 5 to 10 years to go from exploration to development and production. So the next decade is going to be a very significant decade for the industry in terms of profitability and opportunity. While this past decade, one could consider that maybe it's the lost decade for the gold mining sector, this is shaping up now to be an exceptional opportunity for investors to take part in a rising gold price environment in an industry that has consolidated, where values are very compelling for investors at the moment.
And I think that's a good point to shift really to the next slide, which really addresses kind of gold industry production costs, because so often people think, well, gold equities are simply just a levered trade to the price of gold, and that you really want to own the worst companies that are basically on the brink of bankruptcy that are going to do the best when gold starts to go up again, if it goes up again. And clearly the last couple of years we've seen that happen. But there's maybe a little bit more to the story than that, right? So the gold industry production cost is where it is from this chart standpoint, but maybe go into that a little bit more, why that's important and why better operators probably makes more sense in this space as well.
Sure. That is certainly true, Ed, that the high-cost producers are going to give you a lot of leverage to the gold price. But, and I think if you look at the last 10 years or so, the market became disinterested in the gold mining sector because of the high costs, and the market was not comfortable with the trajectory or the profile of the gold price. However, the industry has gained discipline. They have focused on cost cutting. Costs are down significantly over the last 5 to 10 years, and they look to be stabilizing as well, which is, I think, very important for investors to recognize. 7, 8, 10 years ago, the industry was, flush with capital, and they were willing to spend whatever they had in order to realize the gold that they had in their resources. But the market became obviously disenchanted with a lack of profitability, and these companies did have to address their balance sheet and had to cut costs. So we're now into a much better profile for profitability for the industry, where the all-in sustaining costs are down to about $800 an ounce from, say, $1,100 or so 5-7 years ago, which provides a very attractive margin for the sector. So, we're really into an environment where it's somewhat ideal for investors to come into the space as margins have improved. And I think only recently, if you look at the last 4 or 5 months, with the gold price increasing about $150 an ounce, the margins have gone up about 40% or so. And yet the investor market has not really fully recognized or embraced that. They're still very risk adverse to the space.
Yeah, I find it that most people don't believe the numbers yet, right? They don't believe that the margins have expanded by that level or that number.
And even the sell side, who monitors this closely and posts their profit margins or their earnings estimates, is behind the curve. The September quarter results are going to be very interesting for investors who are involved in the space, because there's going to be a lot of surprises. These companies have enjoyed a tremendous price move, and their costs have not moved. So the market's going to be very surprised, I think, in the next month.
That will be interesting to watch that unfold, and we would anticipate, hopefully, that some positive news comes out of that. I think that the last piece on the industry part is probably one of the most interesting things for me to look at, which is gold exploration. What's actually going on in the space right now? And I know we addressed this a bit on page 18. There's a lot of different color points here, but maybe walk people through why it's so important that there hasn't been a lot of gold exploration going on recently, and what does that mean to the overall price of gold and the gold industry from an investment standpoint, but also from a disappearing industry standpoint. Is that healthy? What are the opportunities? And really walk us through this chart a little bit, why this is an interesting chart for investors to look at.
Well, if you look at it, you can observe that in the late 1980s and 1990s, there was a lot of gold discovered, as indicated by the gold bars. And then throughout the 1990s, there was not a lot of exploration activity, and thus there wasn't a significant amount of discoveries. As we got into this century, the sector was doing exploration. There was some discoveries. There were some developed projects. But as we've gone through the last 10 years, there hasn't been the capital available, and as the industry has consolidated, these companies have had to, shift their focus and have not had the availability of capital to do exploration. Why that is important is because, as I mentioned earlier, it can take anywhere from 5 to 10 years to go from discovery and exploration to development and construction and then ultimately production. It's a very time-intensive and rather capital-intensive process.
And I think what you said earlier about the M&A cycle picking up, I think that's partly why we're seeing that part of the world or that cycle start to really get elevated, is because people are realizing, or these companies are realizing, that it's going to be much more profitable to buy than it is to try to build and discover.
Well, that's right. I mean, ideally, to grow organically is always the best. To have a discovery is perhaps the best investment one can make. But in a regard, in this environment where the valuations in the marketplace are so low, there's a strong argument to go out and do acquisitions or consolidate and acquire assets that hold promise, whether they're producing or they could be developed.
And I think, Doug, first and foremost, thank you for taking the time to kind of walk people through the industry side of the business, because I think all too often that gets overlooked when people think about gold, and particularly gold equities as an investment. Having said that, from an investment standpoint, Ryan, I think we've got some great charts to talk about today that think about gold as an investment and how to think about it. So I thought we'd spend the next 10, 15 minutes with you and really talk about gold equities overview from an investment standpoint, how to think about them, why we're excited about them today, and maybe give people on this call a few points to think about going forward and how they need to be thinking about gold equities as part of their portfolio going forward.
Sure. Thanks, Ed. Well, Doug and I spend 100% of our time focused on investing in the gold equity side. So this is obviously a place that we have a great expertise and a great love for, especially at today's prices. And I think, if you think about our overall philosophy of investing in the gold equity space, our first and foremost objective is to invest in gold equities, ones that are actually creating value independent of the gold price. So while we do think the gold price is going to go higher, our fundamental philosophy is to actually invest in those that are actually creating value. And this chart on page 20 here really illustrates the three major phases of any gold mining company. You've got the discovery phase, where people are exploring for and hopefully discovering new gold deposits. You've got the second phase, development, so that's transitioning from the exploratory phase to actually building the project. And the third and final phase, basically production. So you've now developed the project and you're hopefully producing gold at a reasonable cost. And each of these phases is quite distinct, as you can see by the chart, and the value creation in each of those phases. And we have two red arrows there in two particular phases where we have an expertise, and that's in the discovery and development stage. And it really is interesting because a lot of the value is created in those two stages. And so if you look at our portfolio that we manage, our weighting is heavily favored toward the small and mid-cap companies because those are the ones that create, frankly, the most value in the space, as illustrated by the chart. And there tends to be a transition of investor, so you have a lot of gambler types who do the exploration discovery, and then they exit once sort of the discovery's been made. And there really aren't many people to pick up on the development because people don't like the risk or can't evaluate the project properly in the development phase. And so we try to take advantage of those two spots in this chart where we think we have an edge and we can make the most money for investors.
And Ryan, what about, a moment ago, Doug and I talked a little bit about the buy versus build on the cost per ounce. Mm-hmm. And I think, it deserves probably a little bit deeper dive, or to be a little corny, deeper dig into the buy versus build. Talk about what we're seeing there from an opportunity standpoint. Are these things, do we view these as trading as a discount? Like, how should an investor think about a name that could be potentially bought versus a name that has the ability to discover and build? How should we think about that?
Yeah, so if you think about the gold sector just in general, I would say there is starting obviously to be some appetite on the physical gold side, not so much on the equity side, but to the extent there is activity on the equity side, it tends to be in the much more larger and diversified producers. And consequently, there really isn't much appetite for risk in the equity side, and particularly in the development category. And so if you look at these charts, probably the most important is the bottom right one on page 21, where it gives you a flavor for how much it costs if you're actually purchasing a stock and what that implies in terms of gold price. So what this is saying is that basically 2% of the gold price is what people are currently paying. So roughly about $30 an ounce for each ounce in the ground that a company holds. But what's interesting is the chart on the left on the same page shows that it costs $45 to find an ounce. So you can actually buy a company on the market today, on average, for about $30 an ounce, but it costs that same company $45 an ounce to find that ounce of gold. So you're literally buying it cheaper than what any company can do it at in the market. And typically when you get dislocations like this, you tend to see the larger companies start to swoop in and take advantage of the fact that you literally cannot do it cheaper yourself, so they end up buying it. And I think the other thing to note here too is that, as Doug pointed out earlier, you've got a situation where you've got the average mine life at an all-time low at about 12 years, and it takes about that time to actually go through discovery all the way through to the production phase. And so the visibility that large companies have now to replenish their reserves and sustain production is very minimal. And so there really isn't much risk or wiggle room for any of those large companies to take a gamble on finding it themselves. And it makes natural sense for them to start buying.
Well, clearly we're all on this call biased, but man, you could do an entire presentation on page 21 on the thesis for gold equities right now, particularly the last point you talked about the 12-year average mine life cycle relative to what it takes to discover, develop, and produce.
And just a comment there. Several years ago, the mine life was much longer, and so we're seeing. And we didn't really touch on this. We're seeing shorter mine lives because they have not invested. I think another element too, and I guess we could talk about it further, is the grade that these mining companies are exploiting, is lower too. So,
okay.
The deposits are not quite as rich as they used to be. So there's a challenge there as well.
So I think with those two things coupled, I've got to believe that we're going to continue to see an ongoing wave of consolidation, which I think is really feeds nicely into our next slide here, which is talking about the consolidation in the gold industry. we got this aggressive shark taking out this poor, defenseless, small fish. But talk about why that's important. Talk about what you're seeing in the market today. Clearly, you guys own a lot of these names. You've experienced a lot of M&A in our portfolio itself. So talk a little bit about that, where we're seeing the opportunities right now.
Yeah, I mean, we definitely see them in the small to mid-cap space where we're focused. Valuation, obviously, is one here that's clearly illustrative here because you've got basically the larger the company, the higher valuation, and that's exactly what you'd expect, frankly, in any environment, whether people have appetite for the equity side or not. But what's different today is the disparity between the large and the small, sort of the have and have-nots in the sector. And that gap has never been wider from what we can tell from the data that we have. And so it really just clearly illustrates the lack of appetite for risk, frankly. And it goes to also with shareholders as well. So I think, in terms of shareholder activity, in terms of activist campaigns, that type of thing, the shareholders will not let companies invest a lot of money in risky exploration. And so companies have responded by not investing in risky exploration. But it's actually much more risk averse, actually, just to buy something that is more known. And I think that is more likely the path to sort of replenish reserves and resources for the larger companies and use that stronger multiple that they have.
I mean, the recent example is last week in the portfolio, Barkerville was acquired by Osisko Gold Royalties. And for that very reason, Barkerville could not raise the capital to develop a very attractive project in North America, and Osisko Gold Royalties took advantage of the opportunity of that valuation and acquired it and will develop that asset with their expertise and their financial presence in the marketplace.
And unlike some of these markets that we see, maybe in the tech space or the banking sector in the past, where these huge multiples are being paid for these companies, for the most part, we've seen these transactions happen at pretty much fair market value, haven't we? Have we seen a lot of companies get bought at huge multiples yet? Has that even started to happen?
No, the premiums are much lower. And in fact, some of them have happened actually at a zero premium. So Doug talked earlier about a transaction between Randgold Resources and Barrick Gold, two of the largest companies in the sector. And they actually had a 0% premium. And if you actually look at the share price response from that, I think the share price from announcement of the deal to the close outperformed the sector by, I think, 20 or 30%.
Wow.
So if you think about that for a minute, shareholders clearly view that as synergistic. Randgold obviously has strong management, whereas Barrick has strong assets, and they sort of married two good things together, and shareholders immediately saw it. So you're really not getting the significant premiums amongst the larger players, I would say. But it is still true, I think, for a high-quality development project. I still think it is likely that you will get a fairly good premium just due to scarcity value and the fact that, frankly, the prices are so low, whereas the Randgold and the Barricks, who are the larger guys in the space, frankly, I think had reasonable multiples going into the transaction.
Well, and I think it's also interesting to note on this next page, on page 23, this has all been happening with gold quietly marching forward, but not ripping, right? So, every year, as I mentioned earlier, it's stair-stepped about $100 an ounce. We've gold's averaged about 9.5% a year return over the last couple of years. Yeah. But by no means is that a ripping return in the market. So we've seen a lot of significant things happen in the gold space over the last 3 or 4 years here. I wonder what this looks like if gold starts to really move in a meaningful way. If the general market starts to sell off and gold starts to really move, what kind of level of consolidation would you expect to see in that type of environment?
Yeah, no, I think that's interesting. I think, when gold moves a lot quickly, based on my experience in the M&A world, it takes a while for people to recalibrate with one another. And so having it move quickly actually probably isn't the most ideal thing for M&A. However, what will happen if the gold price moves higher is that the largest producing companies will actually strengthen their balance sheet quite substantially. And what's interesting about that is that they'll obviously create their own firepower to buy things. And so when gold price sort of levels off or when things sort of recalibrate between various companies or assets, that is a time where they can deploy that capital and take advantage of some of the pricing that's available, particularly on the small side where we're focused.
I would suggest that, there's a price range where M&A is a little bit more compelling, and that would be, at current prices to maybe $1,700 to $1,800 an ounce. At about that level, $1,800 an ounce, it becomes a little bit of a different exercise where mining companies think about reinvesting their capital
Sure.
at that $1,800. But we would need that type of price level for companies to go out and expand and develop new projects and realize a reasonable return. So we're still $300 or $400 perhaps away from where companies are going to shift from making acquisitions to shifting back into developing new projects or new deposits.
So it sounds like that M&A cycle is probably going to be with us for the foreseeable future, unless we get some really big surprise on the upside in the gold price. It sounds like over the next couple of years, that theme or thesis will continue to play out the way we've seen the last few years.
Yeah, and I think the one thing that's been true with all the M&A that's been done in the last several years of market conservatism is it has to make sense for investors just immediately. And so you've seen that with zero premium deals. You've seen that merging assets that are close by in proximity to one another. Maybe there's a management expertise that one has, the other doesn't. But there's been some element of that that's just always made immediate sense for any of the deals that have been done recently.
Well, and I think, before we shift into just kind of a general outlook of how people should think about the general market, whether it's on the physical side or the equity side, why don't we close with, from Ryan and from Doug, how you guys think about the investment process? Because I think it's very interesting to point out how we look at individual securities from an opportunistic standpoint, and how those ideas work their way into the portfolio, and how we ultimately make money on those particular names on the back end. So maybe just spend a few minutes, if you could, on page 24, talking about the investment process.
Yeah, sure. Well, Doug and I and John focus 100% of our time on this, and we have a lot of experience in many different areas. And I think the biggest thing in this space is to know the companies involved. And we obviously, I think, do a pretty good job at that. We tend to be regarded as sort of an industry leader in the space and as sort of a stamp of approval on someone's shareholder register. And so as a consequence of that is we get a lot of access to management. Comes by our office a lot. So we tend to have 1 or 2 meetings on average every day of the year. And we often go to site. So I was in Mexico last week. I think Doug was there 2 weeks prior to that. And so we really get down to really the nitty-gritty on the operational level. And really that's where we focus a lot of our efforts. So if you look at the universe of the gold sector, you've got about a $325 billion market cap space. So very small space if you think about it in the context of general equities. And so you really have to be focused on the great assets. And that's really what we do. And so what we're trying to find is probably the higher margin assets operated by good management teams with the necessary skill set in that particular phase, whether it's exploration, development, or production optimization. And what we really do is we try to assess whether they have a good plan, whether they can execute on the plan. And so just as a general notion here, we basically tend to focus on the higher quality companies ultimately in the portfolio because they, at the end of the day, have a better chance for high levels of return in terms of reinvestment of capital. Typically, people don't spend a lot of money on reinvestment into an asset that doesn't have high returns. And so our big wins have usually come on companies that have good return potential. And so if you look at our top holdings that we have, a lot of them are small to mid-cap companies with great potential to return high levels of returns on new capital going in. And so when you go through our due diligence process, we've spent a lot of time with management on site, obviously reading all the disclosures and everything like that. And then there's the valuation aspect of things, and you can look at it on a discounted cash flow basis. You can look at it on an ounce per in the ground type of value. And then we ultimately have to exit the investment.
Right.
And so basically our whole philosophy here is investing in companies that add value independent of the gold price. And we tend to exit when they can't do that anymore, because that's a natural period when they're going to have to do stuff that probably they're less good at.
Well, I think that last statement is an important one about independent to the gold price, because so often investors overlook the gold equity trade because they don't frankly understand the overall gold market. And I think working with managers such as ourselves who are looking at these companies on a company-by-company basis, their ability to execute and so forth, I think is a slightly different way to approach the space over and above just a passive market, say, hey, I want exposure to the space, base it off market cap, and move on. I think the quality component of gold equity investing is becoming ever more important, particularly in an M&A cycle that we're seeing.
And I think that's really important to emphasize because, Ryan alluded to that notion that we're looking for the value creation. But I think it's important to recognize some of the different levels of value creation opportunities. It might be through production enhancement, improved productivity, or it might be through discovery, or it might be through resource expansion, or it might be through strategic approaches to M&A or joint ventures, or it might be through balance sheet management. So there's a lot of different elements of value creation. It's not just cost relative to the gold price, which in our portfolio, our average cost for the producers is much, much lower than the index. Which indicates the quality that we're seeking out in the marketplace. It's, the operators are efficient in terms of their production. They're efficient in terms of adding resources, whether it's through exploration or their strategic approach. So there's a number of different elements, which I don't think, investors who maybe are participating in an ETF are really appreciating or capturing. Because our focus is really to identify that value creation opportunity.
Yeah, and I think that's an incredible point to point out because I do agree with you. A lot of people miss that part of the equation, and they scratch their head and say, well, why can't I make money in gold equities? Well, probably investing the wrong way, frankly, and looking at higher quality companies, better operators, and so forth is extremely important in this space. Well, the one thing I know tends to be popular on any panel we speak on or any webcast we do is kind of a forward-looking view on the market. Everyone loves to have a crystal ball and kind of figure out, well, how am I going to eventually make money in this space? Doug, I'll start with you. This year has been a pretty special year for gold. What in your mind has made the gold move in 2019 so special?
Yeah, I think there's a number of elements here. I'll just start kind of from the profile perspective. Gold broke out of a 6-year basing period, which I think is very, very important. Gold has been really ignored, for the last 10 years and was basing for the last 6 years. Mm-hmm. That breakout, we had a number of attempts at 1370 in the last several years, 2016, 2017, but it wasn't until really this summer where we broke through that number. And that's a very important, I think, development. And it comes on the back of this consolidation we talked about earlier. So there's a definite shift in the overall marketplace. Investors are recognizing that central banks are really at a point where they have no alternatives. They can't lower rates any lower. Right. We're beyond negative, and they can't raise rates. And the market is recognizing that there's a significant dysfunction in the global marketplace, and they're looking for alternatives, and gold is responding to that. You're seeing gold rise in every currency, meeting record highs. It's not yet at the record high in U.S. dollars, mm-hmm. but that's just a matter of time. The marketplace has been going to the U.S. dollars in preference to, in deference to the other markets, but gold, I think, importantly, is marking a high point in all currencies around the world, which I think is very telling, and perhaps sometimes investors are too U.S.-centric to recognize that there's another world out there beyond the U.S. shores.
Well, I think the comment I made earlier about being your own central bank, I think that's a very specific comment because of all the different currencies that people do invest in around the world. All the wealth isn't just concentrated in the U.S. dollar and U.S. investors. And what about shorter term? What do you expect to happen over the next month or two in the pricing? It seems like this 1500 is fighting hard to stay there. It gets pushed down, it bounces back up, and so on and so forth. What do you think is healthy right now in the market from a pricing standpoint?
Well, we had a big move this summer, a $150 move. We broke through that resistance level. It's only natural in a market to see a little bit of a correction. Mm-hmm. The technicals would maybe suggest that, we're set up for a bit of a correction. First stop would be about $14.70 an ounce, and then $14.35, and then maybe $13.50 back to that resistance earlier this summer, $13.50, $13.70. But what's notable is how supportive this $1,500, $14.90 price is. It's very indicative of long-term vision, not just traders, but long-term money that's committed to the space. Mm-hmm. And I think if you're watching this space, you'll note that ETFs are at 6-year highs. The accumulation of ETFs haven't been as strong for 6 years.
Yeah.
So there's clearly a groundswell of interest. And if we look at it from the top down, you'd recognize that China bought 100 tons of gold this year, which is set to be a record for them as well. So, clearly central banks, investors are recognizing, I think, some of the unsaid concerns out there on the marketplace and looking for that diversification through gold.
Yeah, and I would agree with that. I mean, Ryan, are you seeing the current buyers out there? Or maybe a better way to ask it are, who are the current buyers? We haven't seen a lot of the retail market, the individual investors, come into the space yet.
No.
So who are the current buyers right now in the market? Why is the price staying around 1,500?
The main biggest buyers today are actually central banks, ironically. So it shows you how much confidence they have in what they're
right.
doing. I think as Doug made a very interesting point, that China actually started buying again.
Mm-hmm.
They were on pause for a number of years, and then only in December did they start their buying program again. And I think that's very interesting because they are obviously one of the largest purchasers in the world. And the one interesting thing just to note about all our conversations from around the world, I mean, there's a lot of interest in this space, but not a lot of people have done it yet. So
Yeah.
It tends to be, I would say, the early leaders in the space. So some of the institutional players, things like that, have done it. But there's still a lot of just forming thoughts about it.
And what should investors be doing then? The typical investor or advisor on the call today, what advice or what plan should they be making for the gold and gold equity trades? How should they be thinking about it?
We would recommend exposure to both sides. So to have the physical bullion as sort of ballast, knowing that it's sort of independent of most other assets in terms of correlation, that type of thing. And then also on the gold equity side, for a couple of reasons. First and foremost, the sector has got to be one of the most out-of-favor sectors in the world, just absent the fact that they mine gold. And the fact that they mine gold, which obviously is a big driver of revenue for them, I think is just a bonus because we obviously think the gold price will be increasing.
I think to that point, Ed, for investors who are, paying attention to gold and looking at gold, the biggest challenge they have is timing.
Mm-hmm.
When do they make that decision? And, the biggest fear one has is, buyer's regret. They bought and then it goes down the next day. I think the approach one has to have is a gold position should be a long-term position. And in order to capture that opportunity, I think you have to invest over a period of time. So I think average costing, however you want to do that, whether it's a monthly or quarterly or on a price basis, averaging in is one of the best ways to get exposure to the space so that you feel comfortable with your investment. And that's the whole point, is to have a comfort level through gold exposure, because that's the whole idea here is to mitigate some of the risk that's out in the marketplace.
Well, and I think you're exactly right about that. And in the interest of time, I'll glance over these conclusions, because you can certainly read these at your leisure. But I do want to save some time for questions. But I think you said something I thought was very important, which is, gold is not designed to replace traditional stocks or even traditional bonds for that matter. It's really designed to enhance your allocation in the broader market. And I'd even take it a step further and say a gold allocation allows you to stay invested in the market, right? We all know you need stocks that pay dividends and have earnings to grow your net worth over time. And gold is not there to replace that, but gold is there to allow you to stay invested in the market over that full market cycle and help dampen some of that volatility and increase your likelihood of success, right? And that's where I think a lot of people misstate or misunderstand the trade, is they think of it as one versus the other. It's like active versus passive,
right,
when they can actually work quite nicely together. And that's really where I think gold comes in as a wonderful diversifier. It's got a proven
really
track record.
a simple and inexpensive insurance policy.
Yeah,
it's
exactly
really
right.
straightforward. I mean, people can make it complicated, but
They
it's
have.
and they have, but it's a very simple insurance policy.
Well, I think with that, we talk a lot about kind of all the things we all are aware of with the massive amounts of debt on the balance sheet, rates continuing to go down, the inversion of the yield curve, and so forth. But what I'd like to do, Natalie, is turn it back to you. I'm just looking. We have actually 42 questions, which clearly we're not going to get to all the questions today. But I will be answering all these questions personally by email to everybody in the coming few work days. But I do want to have some questions addressed on the call today as well. So, Natalie, I'll turn it back to you. and see what questions we have.
Great, thank you, and thank you all for such an informative presentation. As a reminder, a copy of today's presentation as well as additional material can be found in the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your questions in the box to the right of the slides, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. If you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of your screen and confirm the request. So with that, let's take our first question. So it looks like an advisor asked what percentage of a stock and bond portfolio should be invested in gold and or gold equities?
Now, I will admit that I knew this question was coming because this question came in at time of registration. It also happens to be the #1 question we get virtually on every panel, breakfast, lunch, or after-market meeting when we do, and certainly on every webcast we do, which is, okay, I hear you, what % of my portfolio should it look like? And if I was a true gold investor, I would say 100%. But what I would tell you is we did a lot of work with the World Gold Council to try to understand what an appropriate allocation to gold looks like and what benefit it has in a portfolio. And the answer really came back to it depends. And it depends on really your allocation into stocks and your allocation into bonds. So for example, if you had an 80% allocation into equities in general and only say 20% in cash and bonds, then something in the lines of 8 to 10% in gold, whether that's a combination of physical and equity or just pure physical, is going to be appropriate to help diversify your portfolio. Conversely, if you have a very conservatively structured portfolio, say only 20% in equity, surprisingly as little as 2% in gold still added value. And if you actually go and look at, let me just pull this back up, if you actually go and look at page 28, it actually talks a bit about what a 5% allocation versus 10% allocation to a portfolio looks like from a performance pattern standpoint, but also from a volatility standpoint. And what surprises most people is that old opportunity cost isn't really prevalent in the gold allocation. In fact, over time, not only does gold enhance your overall returns, it does so by reducing your overall volatility. But the answer to what % of it should represent your portfolio really comes back to you as a question of, well, you tell me how much risk you're taking on your portfolio from an equity versus bond standpoint or equity and cash standpoint, and then we can back into there what % of a portfolio should have gold and or gold equities in it. But I think these two charts, chart 27, which I briefly skipped over, which just shows a general allocation, and then going back to chart 28, gives you a good example of what it looks like and what % you should think about in a gold allocation.
Thank you. And the next question reads, an advisor is wanting to know where the gold-silver ratio is going and what's the best way to play the spread narrowing.
Sure. I'll take the first part of that, and I'll turn it over to I'll turn that one over to Doug, I guess, on the second part, because that's a much more complicated question. Right now we're at about 85, and the long-term average sits around 60, 62. It did peak earlier this year at about 95 when gold was moving and silver sort of seemed to be forgotten. But that's where the ratio has been. But how should one think about that, Doug, from an investment standpoint?
Yeah, I think people should think about both silver and gold as precious metals. They're both monetary metals. The thing about silver is it's also an industrial metal, so it's a little bit more complicated with regard to its supply and demand in the marketplace. But typically what we've seen is when gold moves, silver will move with it, but on a percentage term much greater. Gold has just moved significantly in the last 4 or 5 months, and silver has had a little bit of a move here. But I think we could see the silver price well into the $20 over the next year or so as the marketplace recognizes that, hey, here too is a precious metal that hasn't quite participated yet. This whole move in the whole precious metals complex has just begun. We're up against 1360, 1370 for about 3 or 4 years, and now we're just gone through that. So it's very much start of the game.
Thank you. What else we got, Natalie?
Perfect. The next question, can you comment on your U.S. dollar view, and is your outlook positive on gold even if the dollar manages to continue strengthening at the margin? So is it possible in today's world that no matter what the Fed does, it cannot weaken the dollar?
Ryan, you want to tackle that one?
Yeah, sure. I think with gold and in the interest rate environment that we're in, gold can do very well as it's done so far. And, I think as Doug highlighted earlier, gold has been hitting record prices in basically every foreign major currency in the world. And it would be probably advantageous for Trump and his policies to have the U.S. dollar lower. But obviously that has not been happening due to the safe haven factor. So I guess in conclusion, you would not need necessarily a weaker dollar for the gold price to do well. And just coincidentally, on the gold equity side, just to wrap that into the conversation as well, most mining companies have mines located outside of the United States and therefore spend the local currency dollars in terms of their costs. So even if there was actually a strong U.S. dollar, you'd actually get the benefit of having weak foreign currencies in lower operating costs for all the mining operations.
Thanks, Ryan.
Great, thank you. Another question, do you believe a gold ETF will be a good proxy for investing in gold during the next secular bear market, or should one also hold physical gold such as coins?
Well, the coin bar equation is a tough one. It depends on really what your purpose is. If you're building an overall diversified portfolio, coins and bars are sort of hard to track, particularly if you're a financial professional allocating for multiple investors. There's really two schools of thought in the gold allocation. A typical ETF simply giving you exposure to spot price if you're talking about the physical allocation. If you're talking about the equity allocation, there's a lot of different ways to do that. I think Doug and Ryan both talked about the value proposition. You can look at gold equities in an ETF based off market cap, or you can look at it based off several factors that matter, like in our ETFs, or look at it from an active standpoint of looking at true quality trades from a value standpoint of how the allocators and the management and the quality of the sites and so forth play out. So I would lean probably more towards active management on the equity side. On the physical side, it really depends on your view on the broader markets. For some, getting exposure simply to spot price is enough, and a typical ETF is probably appropriate. But for others like institutions, and particularly family offices that are looking to get some of their capital outside the traditional financial markets, it becomes mandatory for them to own the physical metal directly. This is a bit of a product pitch on my part, but what I would tell you is Sprott's one of the few unique firms out there that offers a physical trust that allows you to either own physical gold directly, physical silver directly, or a combination of both gold and silver in our physical gold and silver trust directly. So it allows you to own those physical metals. They're fully allocated to you, the investor. You own the actual bars. You're removed from all counterparty risk and so forth. So it really depends on the investor what their end game is on their allocation. ETFs are a wonderful starting point, but for those that want to have a true allocation to the space, I think you need to go a bit deeper. And firms like us at Sprott, we really feel like we can help advise and consult you on how to think about that space appropriately.
Great, thank you. The next question, someone would like you to comment on the gold up, GDX, and GDX down.
I'm sorry, GDX up and GDX, gold being gold up and then GDX and GDXJ being down, meaning the gold equities haven't participated as strongly as the physical market. Is that what it's saying, or something along those lines?
Yes, I believe so.
Okay, great. So maybe
I'm
Doug,
happy
why don't
to
you jump on that one?
That. We've talked about how the gold price move has really been rather recent, and I think it's not unusual for the gold price to move first before the equities. The equities have been flat for the last really 10 years. They haven't done much, and I think investors are seeking the initial and immediate exposure to gold through the gold GLD, the ETFs. But it's just a matter of time where the market recognizes that the gold equities are very inexpensive, and yet they're bound to become very profitable with this price expansion. So it's just a matter of time, I think, where that divergence shifts and the two move together.
Great, thank you. And it looks like we have time for just a couple more questions here. So the final question reads, how liquid is gold relative to other assets such as stocks and bonds?
Well, I could start with just saying very liquid, but I'll ask Ryan or Doug to give a little bit more sophisticated answer to that. Ryan, you want to hit that?
Yeah, sure. I mean, gold, whether it's physical gold or futures or the equities, but particularly on the future side and the physical space, it's actually one of the top 5 most liquid assets in the world, just under U.S. Treasuries, JGBs, and a few other foreign currencies. So extremely liquid market. Prices are almost universally consistent, and it's a market that actually operates 24/7.
And that's why the central banks have been accumulating gold over the last 10 years.
And you guys correct me if I'm wrong, but I read that physical gold is now the 3rd largest asset on central banks' balance sheets. Is that correct?
I believe it is, yes.
Okay. Well, Natalie, with that, I know we've got a lot of other questions here. I will spend the next couple of days responding to everybody by email. I did forward the presentation deck to page 32, where you have my direct contact number and email address. So any further questions you have or questions that were answered that you want more detail on, please feel free to email me directly. You can also reach out to our team desk and speak with my colleagues Sergio and Matt, who are well-versed in virtually everything we talked about today. You can reach them at 888-622-1813, or simply just email us at invest, I-N-V-E-S-T, at Sprott, S-P-R-O-T-T.com, and we would be delighted to get to know you a little better, learn more about your business, and how we can advise you on the gold trade. So with that, I'll thank you for your time, and I will be reaching out to everyone that we did not get to on the call with their questions via email in the coming days. Thank you.